Friday saw a market shock, Monday saw a big sell-off, and since then most major markets around the world have staged something of a comeback after Brexit Friday. Is it a dead cat bounce, or is this the beginning of a turnaround as the world got over its fears around Brexit? Where does one invest in a Brexit-driven market? Can you Brexit-proof your portfolio? Can you weather the storm, or is it just too late? Often the time comes when you're ready to panic and it's far too late to panic. Joining me from our Cape Town studios, Chris Freund, Portfolio Manager of the Discovery Balanced Fund. Let's talk Brexit this evening, Chris Freund, if we may. Too late to panic? I would suggest it is.
I think it is. But having said that, I am very surprised at how well the market is taking Brexit. Or if you think about it, if I'd said to you, look, the vote's going to go, they're going to leave, but don't worry, within the next 6 days, markets are only going to be down on a net basis about 4%. I just wouldn't have believed that. So I think markets are unbelievably sanguine about the whole thing. And that goes to why. And I'm sure you've seen, there's a lot of speculation as to whether they are actually going to go or not. In the FT today, there's a big article about the legality of it, the fact that it's just an opinion that's supposed to get voted through the UK Parliament, etc. My own view is that there's no doubt they're going to go. They had a very clear message from the electorate, and for a government to go against that, I think there's going to be all hell to pay. But I think that's one of the reasons why the market is actually holding up quite well now.
But that degree of uncertainty, it was the uncertainty of what the consequences of Brexit would be, and what seems to have calmed markets is the uncertainty of whether or not there in fact will be a departure from Britain in the European Union. Britain integral in the European Union for 45 years. It's been described variously as a divorce in slow motion. It's got numerous other attributes applied to it. I mean, your colleagues in London must be feeling, if nothing else, somewhat shell-shocked after the events of the last week or so.
They are on a personal level. There's no doubt about it. And I'm sure much has been written and much is going to be written still about how their supposed economic elite was so astonishingly out of touch with the vast majority of the population's thinking. At a professional level, my colleagues are not that anxious about the impact on markets. Interesting. We share what's called a global asset allocation meeting on a monthly basis, and it was fortuitously timed for yesterday afternoon with Investec Cape Town and London. And their view is that it's not that serious in the sense that the UK is obviously a very small portion of global economy, and the global economies roughly are going to be able to continue to muddle through. I have positioned our clients' portfolios here in South Africa for Discovery quite a bit more cautiously than that. Just because, as you know, are the Dutch going to go next, etc.? How France going to take this? And normally markets price in some of the downside of any potential downside uncertainty. They don't price it all in, but they price in a fair chunk of it. And this is just going to be messy for a while. And I'm not convinced that we should be taking a lot of risk right now.
What's been so interesting about this is that many South Africans, of course, have got connections to the United Kingdom. Many South Africans very depressed at having to pay 25 Rand for a pound. Suddenly, you're paying between 20 and 21 Rand for a pound. Britain just became a whole 10% cheaper to visit. Even in Rand terms, it became 10% cheaper to invest in. Do we start seeing opportunities in the likes of Capital and Counties, which has been bludgeoned, Brait, which has been beaten, Netcare, which has been nudged lower? I can't think of any more alliteration, so I'm going to stop there. But my point is made, I think, of South African companies with operations headquarters in the UK.
No, that's a good question. It's been astonishing how vicious the UK property market has been hit. As you know, as you say, Capital and Counties was one of the darlings by the SA institutional community or SA investment community, because it gave you that rand hedge protection in what was seemingly a one-way bet of the rand weakening against the UK pound. I don't know whether Capital and Counties is a cracking investment right now. I do know that the sort of fundamental outlook for UK property has got worse, or certainly had a whole dollop of uncertainty about its future prospects thrown on top of it. They are trading now, for example, that type of share is trading at a 15% odd discount to its net asset value when it's historically traded at a premium. It's not for me right now. We're not buying Capital and Counties at this stage, nor some of the other ones. I think it's time, personally, I think it's time not to get too aggressive about looking to make a lot of money. This is now more time to protect the capital or your client's money that you have. And then when things become, when what we call tail risks, or the chance of something really nasty happening start to recede, then you can put your toe back in the water and look to sort of take up your risk asset weighting generally. And our risk right now is that we sort of underperform rising markets, and that the markets take the view this isn't very serious. But you know what, we'll still make money in absolute terms. And should political shocks, or should more political accidents unfold over the next 6 to 12 months, then we'll just have a lot of powder dry. So we have more defensively orientated portfolios now. Companies like British American Tobacco, not hugely cheap, but hugely defensive in terms of their earnings prospects. We like Tiger Brands a whole lot. We've been very vocal about this for quite a long time. It will rain again one day in South Africa. If you look at the predictions of La Nina forecasts, that type of share. I think the Netcare, too late to sell. Possibly a buying opportunity now. Just gashly now. You know, don't try and swing for the fences at this stage in the financial markets. So one last comment, Bruce, is that where there perhaps is an opportunity is in all the high-yielding assets. The high dividend yield stocks, as long as that dividend yield is sustainable. And then you can see that emerging market bonds are catching a bid around the whole world. Because if nothing else, this last week has meant that any central bank dreaming of putting up interest rates right now is not going to do it. I think South Africa as well, by the way. I think we've seen the last rate hike in South Africa as well, but I wouldn't bet the farm on that one, but I think so as well there. And so emerging market and South African bonds are doing very well now, as will high yielding shares in a world that's going to have low interest rates for a very long time.
So, Chris Freund, this is positive for South Africa then. If our bonds look attractive because of the high yields relative to the rest of the world, and the emerging market complex looks a bit more attractive once again, do we go to this period of slightly better rand performance, which then keeps a lid on the inflation picture a little bit? You say it's going to rain again in South Africa, which meant good on food inflation. The South African environment then in this second half of the year looks a little bit more positive from not necessarily an investment perspective, but certainly we get a little bit of help on the economy.
Short answer, yes, to all of that. Long answer is that political risk could upset all of that, as we discovered in December, and again in, I think it was February. But I buy that argument of yours, that I think that the rand will behave itself for the reasons you just talked about the sort of appetite for high yielding assets which are available in South Africa. I do think that the current account deficit is eventually going to start shrinking. I have thought that for a while and been wrong, but I really think it's going to happen now. Current account deficit is going to shrink, and that's rand positive. I think the budget deficit will roughly behave itself under the steady guidance of the Treasury Department. So for all those reasons, I think the currency will stay in the range of, I don't know, somewhere between 14.50 to the dollar to 15.50 to the dollar. Should that be the case, as you point out, inflation is going to fall quite meaningfully from about December this year onwards. It's going to rise for the rest of the year. It's fairly baked in the cake already, given base levels and what's happening to food prices. But thereafter, in Q1 and Q2 next year, you should see inflation falling. And I would wager that the central bank, Lesotho and co, are going to be under pressure to cut interest rates this time next year, which is good again for shares like banks, for retailers, for bonds, for property shares. So there's a whole chunk of assets that could do well. The problem is there's two big political things that have to happen between now and then. One is we've got to get over the August elections, August the 3rd municipal elections. And I think the consensus views right now are that the ANC will lose some votes, mostly to the left and a little bit mostly to the EFF and a little bit to the DA. I mean, I reckon that's the consensus view in the markets. That's not the issue. It's how the ANC behave economically, should that be the case. And
do we dodge the downgrade? Do we dodge the downgrade come December?
That's what I was going to say. The rating agency. I personally think we will dodge the downgrade. It was absolutely consensus 6 weeks ago that if we avoid the downgrade now or in June, we'll definitely get it in December. And I wouldn't bet my house on that happening at all. I'm not convinced we'll get a downgrade at all in December if currency behaves, current account deficit comes in, the budget deficit continues to be reasonably managed, and we get a half reasonable behavior around the August elections, and the ANC don't noticeably shift economic policy to the left. So, yeah, I don't think we're going to get a downgrade, but I don't know. I mean, no one really knows at this stage. We'll have to unfold and watch those unfolding events that I've just listed as they happen.
Chris Freund, we'll leave it there. Thank you. Portfolio Manager of the Discovery Balanced Fund, joining us this evening from Cape Town. Yep, it's interesting. I mean, Brexit, not all bad news, and the uncertainty in other parts of the world actually turning into positives for emerging markets, including South Africa. Thank you for giving us your time this evening. I hope you enjoyed the show. Do join us again next time on the Moneymakers. Till then, bye-bye.